Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nano Dimension stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nano Dimension is a 3D printing company. The company is headquartered in Israel and was founded in 2012. It went public in 2016 and currently trades on the Nasdaq, Frankfurt, and London stock exchanges. Its focus is on the research and development of 3D printed electronics for multi-layer printed circuit boards and the development of nanotechnology-based inks. Its 3D printers can make complex circuit boards that can be used by medical, defense, automotive, education, and many other industries. When a company needs circuit boards made, they have to provide the blueprints to another company so that other company can use a 3D printer and make those items for them. This gives companies a lot of comfort that their information will not get replicated and stolen by another company. By using Nano's printers, they keep all the information in-house. Let's get started with the model. This is a mid-cap company, 2 billion market cap. They're trading at $8 a share and they have 249 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow because they're not bringing in a lot of revenue at this point. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that's pretty small, between $1 million and $7 million a year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is the gross profit. They did have positive gross profit every year except 2017. Below that is operating expenses. And they have a lot of operating expenses because of their large research and development budget. Below that is operating income, which is negative every year. They only pay $390,000 of interest on their debt. Last year was $2.3 million. And the bottom line of the income statement is their net income, which is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex give you your free cash flow. And they have negative free cash flow each year since they're in growth mode and they haven't hit their break-even point yet. They do issue a lot of stock to fund their business. $12.7 million in 2017, $12.5 million, $14 million, and $676 million. Every time a company issues capital stock, it increases the shares outstanding, making your shares less valuable. They're not issuing debt because they're not bringing any money, so they can't afford to pay the interest payments on their debt. Let's look at the capital structure. $667 million of equity, $4 million of debt. They're 99% equity, 1% debt. And they have a really high WACC, 21%. It's a pretty risky stock at this point. And that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $5.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 249 million shares. And we get a calculated stock price of $7. They're trading at $8, so they're trading at a 15% premium. It's a sell according to the model. I could only find one analyst that priced this stock, and their price target was $10. Last year, the 3D printing market had revenue of $16 billion. Next year, the estimate is $26 billion, and then in 2024, it's $41 billion. The way I estimated their future free cash flows, I thought it would be possible for this company to have $10 billion of revenue by 2026, and with a 10% margin, they would have about $1 billion of free cash flow. I used that as my target, and the previous years just fed into that number. This is the stock price since it IPO'd, so it looks like it was close to $80 at one point, but it keeps going down. Every time they issue new stock, the stockholders seem to get upset and sell their shares and push the price lower. This is one of their printers, the Dragonfly. It's priced between $50,000 and $100,000, so it's not cheap. Most individuals will not buy this. It's mainly for larger companies. They have a really high beta, 2.45, so the stock moves about 2.5 times the market. The stock has gone up 1,000% in the past 52 weeks, while the S&P 500 went up 46%. The 52-week low was 70 cents, the high was $18. The stock is trading below its 50-day and 200-day moving average. This is a really liquid stock. About 26 million shares are traded each day. Of the 249 million shares outstanding, 247 million are on float, 11% are held by institutions, and 7% of the shares are shorted. You can see in the past year, this stock has gone up a lot, much more than its industry and the market. But in the past 3 years and 5 years, this stock has really struggled. If you invested $10,000 when this company IPO'd, you'd be at $1,200 today. That's an 88% loss. The biggest shareholders ARK at 3.4%, then State Street, Susquehanna, Yoav Stern, the president, and Group 1 Trading. Let's look at their financial ratios. We can't look at their PE ratio because they have negative net income. Their price to sales ratio is 588, so investors are paying $588 for $1 revenue. Price to book is stock price over book value per share. They're at 3.0, which is better than the median and average of the market. They have negative EBIT, so they have negative interest coverage ratio. They have negative net income, so they have negative ROE. And they have a ton of current assets relative to their current liabilities. It's mainly due to that recent capital raise. They have over $670 million of cash. The company is well capitalized. They had $11 million of negative free cash flow in 2020 and about $670 million of working capital. So they can get through a few years with the cash on their balance sheet before another capital raise. The best way to look at ratios to compare them to companies in the same industry. I've done videos on Canon, Arista, HP, and Supermicro, all in the same industry as Nano. And if Nano has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their price multiples are pretty weak. Their price to book isn't too bad. They have a really high current ratio, negative ROE, but that's better than the average. They're really low in debt. And the average market cap in this industry is 10 billion. They're at 2 billion. And of course, they don't pay a dividend. So to summarize, I have them trading at a 15% premium. This is a really exciting company with some cool products, but it is risky. The stock is really volatile, so you never know when it could go up or when it could crash. I rank their free cash flow as 1 out of 10, their revenue 1 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.